Hey investor friends, I'm Michelle Markey and welcome back to my channel. If you haven't already, it would mean a lot to me and the YouTube algorithm if you could please like and subscribe to my video and YouTube channel, because today I'm going to go through famous hedge fund and activist investor Bill Ackman's 8-step investing checklist, or also known as his 8 principles that he considers before he makes an investment on behalf of Pershing Square Capital Management. And if you listen to his interviews, he sounds so soft and speaks fast that you could almost miss it in the blink of an eye what he says about his investing approach and strategy. So I'm going to break down step by step what he says in his 8-step approach, and also share some clips from his previous interviews where he explains his rationale. And he's a very concentrated investor, much like Warren Buffett and Charlie Munger. So Bill Ackman is a really good super investor to study and keep tabs on his 13F filings of what equities Pershing Square happens to own, and see if we can study and understand some of these businesses that might also be in our circle of competence. So let's get into this checklist.
Our principles are basically: one, invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical.
So did you catch all of his 8 steps that he said rapid fire in about 15 seconds? If not, never fear, because give the following clip a listen to hear Bill further expand on his investing criteria.
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. You know, or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? If those things are true, we found something that looks quite interesting for us.
That was better, right? Okay, so allow me to repeat these steps slowly so we can better absorb these concepts where businesses must, number 1, be simple and predictable. Number 2, be free cash flow generative. Number 3, have a dominant market position. Number 4, have large barriers to entry, or also known as having a moat. Number 5, high return on capital. Number 6, limited exposure to extrinsic risks we can't control. Number 7, have a strong balance sheet and the business doesn't need access to outside capital to survive. And number 8, excellent management and good governance. So those were Bill Ackman's 8 steps, and let's go through these one by one, and I've got a few clips to support his rationale behind each of these steps. When it comes to the first investing checklist item of simple and predictable, let's take a look at Pershing Square's half a dozen positions as of Q4 2021 to see right off the bat among the consumer discretionary positions that 3 of them are food related, with Chipotle Mexican Grill, Domino's Pizza, and Restaurant Brands International based in Canada. And that one happens to own popular names like Burger King, Tim Hortons, Popeyes, and Firehouse Subs. So I think there's hardly any American that hasn't tried food from these popular chains yet. And so these are pretty simple businesses where they sell popular food that a lot of people enjoy, and these businesses continue to generate a lot of cash flow even during recessions. So even during tough times like during the Great Recession, or even during the last 2020 recession, people were still eating food from Chipotle or Burger King, and that was a simple pleasure that a lot of people look forward to when times are otherwise tough. So a lot of these food businesses are able to continue generating a lot of revenues and earnings in spite of whatever's going on. So that makes them pretty simple to understand the appeal of food businesses. And when they're as strong as these ones, it's no wonder that Bill Ackman is heavily invested in food. And previously, he used to be invested in Starbucks, and he has since sold that position.
Starbucks is in a way, a technology company. One of its competitive advantages versus the corner coffee shop is its digital ordering and delivery and contactless way of interacting with customers. I think every business is a technology company.
And so I sort of wonder if Bill Ackman flipped burgers when he was a teenager, because he seems to flip a lot of money out of food businesses, as he summarized how they're so predictable and simple in the following.
So Chipotle, we're back to core Pershing Square kind of investments. So instead of investing in Chipotle when they're doing extremely well and the stock's 730, we wait for an otherwise great company with a great brand to make a mistake and for people to lose confidence in the company and the management, the board. And that's when we can be most effective. And we've been very effective in fast food. First investment in fast food was Wendy's, doubled our money. McDonald's, similar kind of
Involved Burger King at one point.
Burger King, we're still a major shareholder. It's now called Restaurant Brands. We made 3.5 times our money with that company. So it's a space we know well. It's a simple, predictable, free cash flow generative business. It's an unlevered company with a strong balance sheet. They own all their stores, which is very important because they can, when you have a problem, it's easier to fix it if you control the store base. And it's the first, I eat on a regular basis at Chipotle. I eat on a less regular basis at the other fast food companies we've invested in. So I like the food. I think it's healthy. I think it's good for America. I think they got a sustainable moat around their business. And I think the food safety issues they've had, I think they've addressed properly, and it's a matter of time before the customer comes back.
And with item number 2, free cash flow generative, you can think of this as the net cash after a business subtracts for the expenses that went into operating the business, as well as subtracting the maintenance capital expenditures or CapEx, and that went into maintaining the business, and you're left with free cash flows, which is super critically important to Bill Ackman, because as you heard earlier, if you can't predict the cash flows, then you can't determine what a business is worth or its intrinsic value, and then you can't invest in the business. And he was able to figure out the free cash flow trajectory for businesses like Chipotle, where they were dealing with the E. coli situation, and then their free cash flows bottomed out in 2016 before recovering and then having monster free cash flows in 2021. So Bill Ackman proved to be right with being able to predict what the cash flows would be for Chipotle, as well as he's recently invested in Netflix because he believes, among some other factors that I talked about in my video comparing Netflix to Google, he has a lot of reasons why he's bullish on Netflix, but one of them is that it has an improving free cash flow situation, and that will help for investing in its growth and also returning cash to shareholders eventually, as well as he talks about how businesses like Google, Amazon, and Facebook are really powerful cash flow generators because he said the following about them.
Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher.
And if you can develop some private equity type of skills, this can help you with the first 2 checklist items that Bill also talks about.
We're really a private equity firm that invests only in the public markets. And so, several years in private equity, because private equity investors focus on simple, predictable, free cash flow generative businesses and focus on businesses that can support a large amount of debt and really determine valuation, think about industry dynamics.
And with item number 3, dominant market position, this gets at a company's durable competitive advantage, as Buffett likes to talk about, and that relates to a company's moat or their ability to withstand a lot of difficult situations while maintaining their earnings ability. So he has a few things to say about this too with companies like Amazon.
And the more dominant large cap companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates, that are not particularly exposed to the economy.
And with item number 4, large barriers to entry, this also gets at a company's moat, where it's really difficult for other businesses to replicate what one business has going for them, such as with railroad businesses like Bill Ackman has been successful with railroads like Canadian Pacific, and Buffett has been successful with railroads like Burlington Northern Santa Fe, because you can't lay more railroad track really easily. It requires a lot of investment capital to go into the railroad business, and a lot of it has already been decided and determined, and the rights to have railroads go in certain directions has already been established. So that's where there's a huge barrier to entering the railroad business. You can't just easily start a new railroad business tomorrow like you can a software business. So that's one example of where railroads have a moat, where they have a huge barrier to entry. And this is a little different from a dominant market position in number 3, because that has more to do with being able to scale the business, like how Amazon can scale its Amazon Web Services cloud business, and that's where it gets a dominant market position in the cloud area. And with the large barriers to entry, Bill Ackman also cites Visa and MasterCard as to how they were able to establish themselves in this area by saying the following.
I'd said previously, I was asked by, at a business school by a student, what's the single best business in the world? And I said, if you could own a royalty on people spending money, like Visa or MasterCard, it's the greatest business in the world. And if that ever became a public company, you want to buy that company, or if you ever could buy that company.
And with item number 5, high return on capital, we can think of this in 2 ways, as a business and also as an individual investor. And for businesses, they're prioritizing trying to generate returns on their equity as well as any debt that they take on, so that they can lead to returns on invested capital, or also known as ROIC. And this applies to whether investors are trying to get a return out of Fannie Mae and Freddie Mac, as he explains in the following clip, or also if we as individual investors are trying to get the best return possible on any investment that we make, as he also explains in the following.
In order for investors to invest in Fannie and Freddie, particularly in light of the history of the government expropriation of the 2 companies, investors are going to have to earn an adequate return on the capital that they invest in order to invest.
I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. Problem with it is it leads to bumpier returns. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. If you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100.
And with item number 6, in limited exposure to extrinsic risks we can't control, this gets at a couple of things as well. And one of them is that even during uncertainty, we might expect higher premiums for investing in certain things. So we need to be fully aware of the risks when it comes to any investment, as he talks about in this clip. And then also, we should stick to our investing principles so that we don't go outside of the boundary of our knowledge. So this is sticking to our circle of competence, and then we don't have as much risk of permanently losing money if we're fully aware of what we're getting into to begin with. Because if we're investing in things that we don't fully understand, then that sets us up for a lot of risk of losing our money, which we want to avoid as well.
Your risk premium, should go up when there's more uncertainty. And the risk premium relates to the discount rate. It's the risk-free rate plus a risk premium that you use to discount the future. And many rapidly growing companies, you can't justify the value placing a multiple on next year's earnings, which is sort of the convention for many kind of more mundane businesses. You have to make certain expectations about a company's ability to become profitable and for those profits to grow at a pretty rapid rate to justify many of the values or the collective values of where many of these companies were trading. And I think that is inevitably leads to more volatility when there's uncertainty.
And with item number 7 of a strong balance sheet and the business doesn't need access to outside capital, this refers to a business having enough cash to be able to withstand and survive any amount of economic turmoil and uncertainty that might happen. So the more that businesses can afford any debt they have with plenty of cash flows coming in, the stronger in a position they'll be, because the more that companies are leveraged, the more vulnerable they might be when they need capital at the most. So during the 2020 downturn, a lot of companies that didn't have enough cash suddenly found themselves struggling to pay rent or also afford their staff. So a lot of people lost jobs, and some businesses had to declare bankruptcy because the liquidity dried up and they didn't have cash coming in from actually people buying goods and services. So he also talks about this a little bit too.
Obviously, you'd never want to let the liability side of the balance sheet grow too much. So it's something that is concerning. We are fortunate finding ourselves in a very low interest rate environment, but it's something to think about and be concerned about. But it's sort of difficult to do the same kind of calculation of the leverage nature of the United States unless you do a proper valuation of the asset side of the balance sheet.
And finally, with item number 8 on excellent management and good governance, I'm sure the CEO of Netflix, Reed Hastings, is part of the reason why Bill Ackman was willing to invest over $1.1 billion or 3.1 million shares worth of Netflix. And that's about 9% of the Pershing Square portfolio. So that's a huge amount that he invested in Q1 2022. And it's no wonder, because there have been a lot of great things said about Reed Hastings and the way that he has been able to grow Netflix. So that's something to keep paying attention to, as to seeing if that might be a business worth following or investing in potentially. As well as with Chipotle, he was able to help that grow by also saying the following.
We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Niccol. It's completely turned around the company. The stock is almost tripled in the midst of a crisis. And it just tells you that, that's a lot more fun and it's a lot more profitable. And it's, I would say, that a lot more good for America than just simply being a passive stock picker.
And I'm sure that Bill Ackman looks for the same qualities in management that Charlie Munger does, which is that management have integrity and talent, because sometimes you need a really good leader to help a company to reach the next level. And if you appreciated this 8-step rundown of Bill Ackman's checklist, please be sure to like and subscribe to my video and YouTube channel, because I greatly appreciate it, and I'm sure all of these steps will help you be a better investor too. Thanks, until next time.